Good afternoon. Welcome to Green Bicep. This is week number 6. Signal from the noise. So over the last week, the market was up 2.3%, while the Shanghai index was down in China. Australia was nice and steady and flat. So there's a mixture of money moving around. The Federal Reserve raised rates 25 basis points. Well, Powell speaks again tomorrow. So everybody's going to be all eyes on Tuesday on Powell, because he will move the market by what he says. And has the market pricing a rate cut before the end of the year? The answer is yes. So all things being equal, if rates are not cut, then the market's going to be considered overvalued, and typically it'll adjust down accordingly. So what to do? In general, just try to find strength in the chop, whether you're buying or selling. This is a trader's market for now. So coming up this week is housing. We have the starts. We have the NHAB sentiment, the executive's outlook on how they see things. We have Michigan sentiment, the consumer. And on top of that, we also have, of course, the drill count. Then on Friday, the most important thing is China loan growth. How much loan growth was taking place? So the new normal is war, so you can't expect the supply chains to operate like they did prior to what happened in Feb of 2022. Plus what happened with Israel and Iran, plus Azerbaijan's in the middle of that. Yeah, and so there's a lot of tension in that area. In the week to come, we have a lot of earnings from DuPont to Honda. You name it. BP should be interesting to watch. Hertz. So sentiment, the reason why I have this here is typically at a bottom, sentiment will be very fearful and red. So I'm going to continue to watch this, and I expect this to change in the next few months. Interest rates are dropping down. So as we follow the HOPE acronym, housing, orders, profits, employment, and the very first thing to turn over as we go into a bear market is housing. So housing started to turn over. Now we're going up because the Fed was raising rates, but now actually rates are dropping down because the 10-year note started to drop off too. And generally, mortgage rates are fairly pegged to the 10-year note, at least directionally. And you can see here that family starts have ticked up. That's a big deal. We want to see some homes being created. We don't want the downtrend. And then you can see active listings actually drop down quite a bit. So that is good for people selling, because it means price will hold more steady. And unfortunately, the number of days on the market is up to 75 across all homes. So that it's going up. So that will put some pressure on prices from the standpoint of getting what you want. So overall, housing is very regional, and so we're going to be seeing pockets of weakness and pockets of strength throughout the U.S. But overall, the price will probably continue to trend down until this economy truly turns around. And so you could argue, well, it has turned around because unemployment is low. Well, the reason unemployment is low is because there aren't enough workers. Doesn't necessarily like things are like hunky-dory good. Because we'll get into that after this chart. So if you look at this chart, this is looking at the triple B corporate yield minus the 90-year Treasury bill. And when you subtract the two, in 1929 it got down to almost 0%, in 66 close to 0, in 73 close to 0, 79 at 0, or close to 0 in 07, in Feb 23 we're getting close to 0. Well, this is the point before the market crashed. So we're here. It hasn't turned up. So this portends a market correction. Because if you go look back at all these dates, except for one of them, the market like washed out pretty hard after the fact. So just be prepared. I guess the best thing you could do is hedge. You could hedge by being in cash, or you could hedge with different derivatives. So this is looking at the yield curve versus the actual unemployment rate. You're taking the 10-year minus the 2-year. They move together, which is quite they're highly correlated. And so based upon this, you get these inflection points. We're at a very extreme low. We're going to get a zip back up because the yield curve is inverted, and that's not normal. The yield curve will fix itself. You're going to see this black line zip up, and then you're going to follow unemployment rate. It's going to shoot up. That's likely to happen. So here's manufacturing PMI, looking at the manufacturers. And this is a survey-based type of data point where a lot of feedback is given to. And this is, it's very important because you could look at manufacturing, the overall economy, look at by different areas, and you could say, well, what is happening? Currently, manufacturing is contracting. And is it contracting? Is it slowing down? Or is it really contracting? Well, according to this, it's speeding up. So that's not a positive sign. Well, inventories are actually growing, but not as fast. So that means we're building inventory, but at least it's not as fast. And then prices are actually decreasing at a slower rate. So that's good for inflation. Prices are decreasing. Then when you get to, we're still on manufacturing PMI. So 15 industries reported contraction, and steel was the commodity in the most shortage of supply. Then you get into non-manufacturing, 10 services industries had growth. And this makes up of approximately 70% of the economy. So it's important, and this is good. That means the economy is strong. The problem is, like, we're fighting the Fed, and they don't want inflation, and this is where they're focused on. So we have a short supply of brass fittings, paper products. That's interesting. Yeah, so these could be opportunities where to look for potential price pressure, which you could trade off of that. And then next we get into, there it is, PMI services. It's trending up. We got a positive one going on here. And then here's more specific services. You can see business activity is moving up faster. The slope is turned up faster, the rate of change, and it's growing. This is great. Let's look at prices. They're increasing, not what we want to see, but at least it's at a slower pace. So next here, this is looking at the S&P 500 going back to 1998. The yellow line, that is once the Fed started raising rates like they just did. And so they started raising rates in, say, in the late 90s, and then the market started crashing, and then they cut rates. So they started raising rates in like early 2004 or so, mid 2004. Market ran up, they cut rates here, and the market crashed. 2016, they started raising rates, and then we had COVID, and then you can see they cut rates here, then the market crashed, then they cut again actually. And now we're in our current state where rates have been being raised, but normally the market goes up after it, and it's not happening. The market's actually going down, so this is unusual. So we're in a situation where the market is doing the opposite what historically would do, and it's like jumping ahead, trying to like skip a step in the process. But I think, unfortunately, that step is going to play out when you look at PMI. There's no denying it on the manufacturing side. Things are getting weaker. So unless inflation just drops off and goes negative, this will continue, meaning we're likely to have more pressure from the Federal Reserve. So the oil rigs, we continue to talk about this. We're at $5.99. So that continues to drop down. As that more drops down, the more likely we're going to have to get oil from Canada. So it's worth looking at some of the Canadian companies. And then you would also want to look at the Canadian currency pair to the US dollar. And then next, where are we? So are we starting another commodity super cycle? We've broken out on a lot of commodities, and we're above this channel that lasted from 2005 to present. If this holds, we could be in for, it should be interesting to see how this plays out. It's really a function of, you got to get productive growth into the economy. And when I use the word productive, I mean, it means that it's accretive. to society. So the list, I made a few changes on this. You'll see, I'm going to zip through it. The biggest changes are I have a wait list, a political list, the Southeast Asia opening. I maybe moved a little bit around there, but not too much of a change at this point. The list is designed to do fairly well based upon China opening, as well as having the Federal Reserve raise rates. And that's all I have for today. I appreciate your time. Let's quickly look at some commodities. And so what we're seeing here is that orange juice is up. But overall, foods have like tapered off in the last week, which is good. So we're not seeing as much pressure on the agricultural side and food in general. But it's still early for the month. Most foods are up. So we need that trend to change. And until then, we're going to have food price inflation, which is going to mess with sentiment, make the average person to feel a little bit less wealthy. So hopefully that will switch in the next few weeks. And I'll bring another update next week. We want to look for next week is we're going to see the Fed talk. We're going to get a little bit more rigs data. It's like I think this is the time where you just start to make lists of companies and areas of opportunity, because it's going to be a really choppy market, and it's best not to be overactive. You just want to observe and take it all in. If you do that, you'll learn a lot during this period of time. Plus, you won't make overly aggressive decisions, because the best thing now is, from my perspective, is not to be too active. Like a lot of the older guys that are in their 60s and 70s have been doing this for a long time. They're on the sidelines. I mean, they might be deploying a little bit of cash, but as a percentage of their portfolio, it's not a lot. So I appreciate your time. If you like the content, give me a like and subscribe, and I'll talk to you guys soon, and appreciate it. Green Bicep out.